All right, let's get straight into it. We're tackling cost of capital today, and you know how crucial this chapter is for your exams. We're going to break it all down, look at the formulas, but more importantly, I'm going to show you exactly where the ICAI loves to lay traps for students. Ready? Let's do this. Okay, let me ask you something. Picture this. You're in the exam hall. The clock is ticking. You've got a big, juicy 8-mark question on cost of capital in front of you. Where is that one tiny, easy-to-make mistake that can just poof, make 3 marks disappear in an instant? And not just that, it messes up your entire final answer. Have a think. Yep, you guessed it. This is the #1 trap, forgetting to adjust the cost of debt for tax. I mean, you can do all the hard parts perfectly, nail all the complex calculations, but if you miss this one tiny step, boom, mark's gone. It's the classic mistake, right? Well, after today, I promise you, you are never, ever going to make it again. So, to really get why this matters, let's step out of the exam hall for a sec and put on a finance manager's hat. Imagine you've got this amazing project, a real game changer that's going to make the company a ton of cash. But you need money to get it started. So, what are your options? You could issue some debentures, maybe some preference shares, or you could go for new equity shares. How on earth do you decide? Well, you've got to figure out which one is the cheapest. And that, right there, is the whole point of this chapter. Okay, let's get into section 1. So we've got this practical problem, right? Now let's connect it to the theory. So what actually is cost of capital? Think of it like this. It's the rent you pay on money. It's the price for using someone else's cash. I mean, lenders expect interest, right? Shareholders expect dividends and for their share price to go up. Nobody's giving you their money for free. So the return they expect is the cost to your company. You'll also hear this called the hurdle rate or the cutoff rate. It's basically the minimum return a project has to make just to be worth considering. So why should you care about this? Why is it so important? Well, it drives 3 massive business decisions. First, investment decisions. Capital budgeting stuff. You use this rate to figure out if a project is actually gonna make you money. Second, the financing decision we just talked about, picking the cheapest way to get cash. And third, something you might not think of, like designing your credit policy. You have to know your cost of capital to see if offering credit to customers is worth it. Definitely remember this for your theory questions. All right, first up on our calculation journey, the cost of debt, or KD. People often say this is the cheapest source of funds, and you're about to see exactly why. Okay, first things first, when you see a debt question, you have to ask, what kind of debt is it? Is it irredeemable, meaning it goes on forever, like a perpetuity? Or is it redeemable, where you pay it back after a set number of years? Because believe me, the formula you use is going to be different for each one. So for irredeemable debt, the formula is pretty simple. You take the annual interest, you adjust it for tax, and you divide it by the net proceeds you got when you issued it. Now, look at that formula. See that 1 minus t? That little piece of the puzzle is everything. It's the tax shield. Why? Simple. Interest is a business expense. It lowers your taxable profit, which means you pay less tax. That tax saving is the superpower that makes debt cheaper than other options. Okay, I need you to listen very carefully. If you remember one thing from this entire explainer, let it be this. Interest is tax deductible, preference dividend is not. Say it with me. Interest is deductible, preference dividend is not. This is the golden rule. It's the biggest difference between the two, and it's where countless students lose easy marks. Don't be one of them. Okay, now for redeemable debt. I know, that formula looks a little scary, right? But trust me, the logic is super simple. Just think about it in 2 parts. The top part, the numerator, is just your average cost per year. That's your interest after tax plus any profit or loss from redemptions spread over the years. The bottom part, the denominator, is just the average amount of money you had over the period. That's it. RV is just what you redeem it for, and N is the number of years. Let's put this into practice with a classic ICAI example, illustration 2. The key to these questions is to pull out the data first. So what do we have? The annual interest, I, is 10% of the face value of 100, so that's 10 rupees. Net proceeds, or NP, well, it was issued at a 10% premium, so we got 110 rupees. What about the redeemable value, RV? It's redeemed at par, so that's 100. The life, N, is 5 years. And finally, the tax rate, T, is 35%. See, we've got all our ingredients. Okay, time to plug everything in. Let's do it step by step so nobody gets lost. First, the top part of the formula. We need the after-tax interest. That's 10 rupees times 1 minus 0.35, which gives us 6.5. Easy. Next, that redemption part. It's 100 minus 110 divided by 5 years. So that's minus 10 over 5, which is minus 2. So our whole numerator is 6.5 minus 2, which is 4.5. Got it? Good. Now for the easy part, the bottom. The average value is just 100 plus 110 divided by 2. That's 105. So we're left with 4.5 divided by 105. Punch that into your calculator, and what do you get? 4.29%. Done. It's not so bad when you break it down, is it?
Now, here's a little secret, an important exam tip straight from the ICAI material. That formula we just used, it's technically an approximation. It's not 100% perfect, and ICAI could totally ask you about this in a theory question. So what's its weakness? Well, it gets less accurate if there's a massive gap between the net proceeds and the redemption value. Just a little nugget of information to keep in your back pocket.
All right, we've nailed debt. Moving on to Section 3, preference shares. These are interesting because they're kind of like a hybrid, a mix between debt and equity. And just like with debt, you've got your irredeemable and redeemable types. Now look really closely at those formulas. The redeemable one looks almost exactly the same as the debt formula, doesn't it? But what's missing? Come on, you know this. The 1 minus t is gone. Why? Because, say it with me, preference dividend is not tax deductible. This is the ultimate ICAI trap. They will give you a tax rate in the question, just dangling it there, hoping you'll bite and use it. Don't fall for it. Let's run through the numbers real quick. Illustration 6, irredeemable. Dividend is 10, issued at 95. So, 10 divided by 95. Boom, 10.53%. Now, illustration 8. Same deal, but redeemable in 10 years. The top part is your 10 rupee dividend plus the redemption cost. That's 100 minus 95 divided by 10, which is 0.5, so 10.5 on top. The bottom is the average of 195, which is 97.5, so 10.5 divided by 97.5 gets you 10.77%. See? No tax anywhere.
Okay, we've crushed the easy ones, the fixed cost stuff. Now it's time for the main event, the cost of equity. And I call it a challenge for a reason. With debt, you have interest. With preference shares, you have a fixed dividend. But with equity, what do you have? There's no fixed payment. We're trying to figure out what the actual owners of the business expect to earn. And that's tricky.
So how in the world do we calculate it? Well, that's a thing. There's no single magic formula. What a shareholder expects depends on a whole bunch of stuff. Dividends, earnings, future growth, risk, you name it. And because it's so uncertain, we don't have one formula. We have a whole toolkit of different models to help us estimate it. So your study material basically gives you a toolkit with 5 main ways to crack this. You've got the dividend price approach, the earnings price approach, the growth approach, which you'll probably know as Gordon's model. Then there's the realized yield approach, and last but definitely not least, the big one, CAPM, the capital asset pricing model. We're going to go through all of them so you know exactly which one to use and when. All right, let's start with the first couple of models from our toolkit, the dividend and earnings approaches. Okay, let's put these two side by side. They're pretty similar. The dividend price approach is super simple. It says the cost of equity, KE, is just your expected dividend per share, D1, divided by the current market price, P0. It focuses only on what's actually paid out. The earnings price approach is basically the same idea, but instead of dividends, it uses the total expected earnings per share, E1, and divides that by the market price. So this one looks at everything the company earns, whether it pays it out or not. The key assumption for both? They both assume there's no growth. The cost of retained earnings, or as we call it, CAR. Now, this is a super critical area. Understanding the why behind it is the first step to crushing the problems. So back to our question, is that reinvested money free? And the answer is a big fat no. It's absolutely not free. Its cost is an opportunity cost. Think of it this way. If the company had just paid that money out as a dividend, what would the shareholders have done? They would have invested it somewhere else, maybe in another stock or a mutual fund, and earned a return. That return they gave up, that is the real cost to the company. So KR is basically the minimum return shareholders expect the company to earn on their money. And now this slide here points out a really key distinction, the difference between KE and KR. Think of KR as the cost of internal equity. It's money that's already inside the company. KE, on the other hand, is the cost of external equity.
That's money you raise by issuing brand new shares. And when you issue new shares, you have to pay things like brokerage fees, underwriting commissions. We call those flotation costs. Since retained earnings are already there are no flotation costs. And that right there is why KE is pretty much always going to be higher than KR. You've got to remember that. Okay, let's get into the math. The theory is important for sure, but ICAI is going to test you on applying the formulas. So let's get comfortable with the numbers.
And here's some good news for you. You don't need to learn a bunch of brand new formulas. The methods we use to calculate the cost of retained earnings are the exact same ones we use for the cost of equity, the dividend growth model, and the capital asset pricing model. Let's see how they work. First up, the good old dividend growth model, or DGM. The formula should look pretty familiar, right? KR is simply D1, which is your expected dividend, divided by the current market price, P0, and then you add the growth rate, G. And remember, D1 is just your current dividend, D0, grown by 1 year. So let's use the data from a typical ICAI illustration. They've given us a current dividend, D0, of 4.19. The market price, P0, is 50, and the dividend growth rate, G, is 5%. Looks like we have everything we need to just plug and chug. And here's how it works out. First, we find D1 by taking 4.19 and growing it by 5%. Then, we divide that result by the price of 50. Finally, we add back that 5% growth rate, do the math, and you get a cost of retained earnings of 13.8%. Simple as that. Okay, on to our second method, the capital asset pricing model, or CAPM. The formula here says our required return, our KR, is the risk-free rate plus beta times the market risk premium. And that market risk premium, well, it's just the return on the market minus the risk-free rate. Let's look at another ICAI problem. The risk-free rate is 7%. The company's beta is 1.20. And, pay attention here, they've given us the market risk premium directly as 6%. This is important because sometimes they'll give you the market return and the risk-free rate separately, and you have to do the subtraction yourself. So always read the question carefully. Plugging these values in is super straightforward. It's just 7% plus 1.20 times 6%. That gives us 7% plus 7.2% for a final KR of 14.2%. And just like that, you've mastered the two main ways to calculate the cost of retained earnings. So, we figured out the cost of one piece of the capital puzzle. But hey, remember our CFO's challenge? He didn't want just one piece. He wanted the overall cost. And that brings us to the big picture, the weighted average cost of capital, or WACC. WACC is pretty much exactly what it sounds like. It's a blend, a weighted average of the costs of all the different kinds of money a company uses: debt, preference shares, equity, and of course, our friend, retained earnings. This number represents the minimum return a company has to earn on its projects just to keep all its investors happy. This is your benchmark. This is the hurdle rate. And you know what? Calculating WACC is a simple 4-step recipe. Step 1, add up all your capital. Step 2, find the weight or proportion of each piece of the pie. Step 3, multiply each weight by its specific after-tax cost. And step 4, just add up all those products. That's it. Follow these 4 steps every time and you can't go wrong. Okay, we've arrived at a very, very important section. Seriously, this is a spot where a ton of marks are either won or lost in the exam. Choosing which weights to use. Should we use the book values straight from the balance sheet, or should we use the current market values? This table here breaks it down perfectly. Book value? Yeah, it's easy to find and it doesn't change much, but it's based on historical costs. It's old news. Market value, on the other hand, reflects what investors are thinking today. It's the true current economic value. So the main takeaway for your exam is this. While book value might be simpler, market value is way more accurate and it is the theoretically superior method. Always prefer market value if you can get it. Okay, the theory is done. Now it's time to put on our exam hats and apply everything we've just learned to a full-blown ICAI-style problem. This is where the rubber meets the road. So here is a typical WACC table that you'd build in an exam. You've got your sources of capital, their book values, their market values, their specific costs, and then you calculate the final weighted cost. But wait a minute. Take a close look at the market value column for equity shares and retained earnings. Where did those numbers, 1.6 crores and 40 lakhs, actually come from? It's not obvious, is it? And here is the secret. This one little sentence, often kind of hidden in the notes of the solution, is the entire key. The total market value of the company's equity, which includes both share capital and retained earnings, has to be split between the two. And how do you split it? In this case, you apportion it using the same ratio as their book values, which happens to be 4:1. This right here is how ICI loves to twist the question. Let me be crystal clear. This is an ICAI trap. I've seen it 100 times. This is where marks are lost. Students do all the hard work, they calculate the total market value of equity correctly, but then they forget to split it between share capital and retained earnings when they're using market value weights. Please, please always check for this apportionment. Don't just dump the entire market value under equity shares and call it a day. And that brings us full circle, right back to our CFO. We've calculated the WACC, we have our number. That number is the hurdle rate for any new project the company considers. So the final question is, which projects do you accept? Well, it's simple. You only accept the ones whose expected return is higher than the cost of capital you just calculated. See? Mastering this isn't just about passing an exam. It's about understanding the absolute core of financial decision-making.